How are we doing today, folks? Good. So I apologize, first of all, for not having the camera on. I know nobody in the room, but people watching this on YouTube are going to wonder why the video's on. The reason why is because apparently I've gone to heaven, all right? And yeah, it's just a big pale photo of white. It's very, very bright. You can kind of see me moving around in the background a little bit, but not very much. So I figure rather than sharing that, I'm just going to say no video screen whatsoever. So you're gonna have to deal with the dulcet tones of my voice and have to have that just be your guide for today. So we are on the tail end of comps from last night. How do you guys feel about comps from yesterday? So this group was actually one of the more sensible groups that I've actually done comps for, because every single person in the audit track and every single person in the tax track apparently said, we're going to answer the two questions in our track and then just go to another track question. And made it simple as possible. This is the first class that I've been here for 10 years that's done that. Okay, so kudos to you guys for keeping things simple. That being said, I have a little bit of a problem. There were 23 people who took comps last night. I think it's 23. It was maybe 22, but I had 16 questions on audit, 16 questions on both audit questions, which is correct because I got 16 questions or 16 people in each track. And then there were 8 people in the tax track for each question that Dr. Kidd answered. Now, if you do the math, that's 16 plus 8 is 24. Okay, which means somebody in audit was moonlighting on the tax side. Okay, I don't know who it is. I don't know yet. I haven't done that investigation, but when I find out, I don't know what's going to happen when I find out. I just thought it was funny. Okay, yeah, nothing's going to happen to find out. But yeah, if you dare to answer the tax question. I mean, I've had tax students actually answer audit questions. Everybody seems to love that fraud question for some reason. So apparently creating a fraud is something that students are really good at. All right, we got stuff to talk about today, so let's get at it. So first thing to talk about is bad blood. Actually, was it you, Dylan? Were you moonlighting on the tax side?
Again?
Or comps, did you moonlight on the tax side yesterday?
Not.
Okay, we're trying to figure out because somebody moonlighted on the tax questions, and I don't know who it is yet. I'll figure it out once I look at the list of questions. But the numbers don't add up. It's 24 people that answer track questions, but there's only 23 students in the program. Unless somebody just jumped in and just decided to do comps yesterday and was not part of the graduate program, which I'm not sure how that works, but yeah, it's weird. So one of those things I'll figure out. Yeah, so getting back to bad blood. So started out talking about how Joe and Richard Fuse kind of gave up the lawsuit against Theranos, and I don't know. I didn't particularly like Richard Fuse as a person, so it's hard to feel too bad. But it's just like, who do you root for in that situation? It's like Richard Fuse is a greedy, grinchy old man, and then you've got David Boyce, who's an unethical lawyer, and you just want to kind of root for both of them to lose. And so, but yeah, Boyce and Theranos, they ended up winning, and Fuse basically gave up. And yeah, so yeah, Richard Fuse gave up the lawsuit, and then they were talking about how this lawsuit was attracting public attention, and we ended up parlaying into this interview that Roger Parloff did for Fortune magazine. And they did a picture, and here's actually the image from Fortune magazine. The CEO is out for blood. It's Elizabeth Holmes, okay, and talked about that in the book. And just an iconic image now. Now we know in retrospect what's going on, but this kind of vaulted her to superstar status. And if you pay attention to the book, this was kind of this is kind of what her ultimate goal was, is that she wasn't trying to get out there to revolutionize blood testing. I mean, healthcare or anything like that. Her goal at the very beginning of the book was she wants to be a billionaire. She wants to be famous. And I think the statement in the first or second chapter is, or maybe the first chapter is the prologue, and then chapter 1 talks about her background, saying that she's going to be so rich that the president would want to marry her. And so she's kind of accomplished that. Now she's a diva. She's actually just enjoying the celebrity and the fandom, and she's not really running the company anymore. She's just kind of treating herself like a Hollywood starlet. And you know, kudos for her, because it's not going to continue for very long. That's all I can say. But yeah, company's still kind of doing questionable things. And then after that, what happened? We actually go to talk to Alan Beam, and Alan Beam is having a rough time of it. He's saying that the company is regularly failing their CLI inspection requirements, and they regularly fail proficiency tests, and people are always calling to him complaining. And He's just like, you know what? I've had enough of it. I'm going to quit. But he does something very clever. He sends a whole bunch of emails to himself over Gmail, which obviously Theranos is not going to know anything about that, right? Wrong. They're tracking his activity on his computer, and they're basically saying, by the way, that's something to keep in mind when you go off to work in public accounting or private industry, whatever it is. Always assume that your employers knows what you're doing. So if you are don't want your employer tracking you doing stuff, make sure you don't put your computer on stuff. Now, I'm not saying that you should be up to unsavory activities, anything, but just something as innocuous as going and see what the scores are at a sports game on ESPN might be enough to trigger something like that. So just keep in mind to keep your personal life and professional life separate. But yeah, always assume they're watching, and in this case, Theranos was, and they said, yeah, hand over your emails or hand over your laptop or your computer account so we can wipe your personal account clean of the emails. And so he tried to fight it. He tried to fight it and didn't end up working out because he paid $10,000 to a lawyer, and the lawyer basically says, yeah, you should give up. I would be like, give me my money back. Give me my $10,000 back, a $10,000 retainer. And this is, yeah, you should just give up. That's just brutal. But yeah, he ended up having to delete all his emails from busted. But then we had our friend Richard Fuse, who's not done. He's still really, really upset, and he still wants to get revenge, even though he said this matter is ended. He still wants to get revenge on Theranos and Elizabeth Holmes, and gets a call from our Alan Bean and says, "Yeah, you know the Hippocratic Oath and all that. That forces us to be good physicians." And of course, Richard Fuse is like, "I'm the best physician." Yeah. And so he basically forwards it on to somebody called Adam Clapper, who actually is a physician down in Columbia, so about an hour and a half south of here, runs a blog called the Mythology Blog, and he's about to reach out to this one. And I love the way that the chapter ends. It's like, okay, the hero is about to come upon us, the hero who will save us all from the evil that is Theranos. And of course, as you're going to find out, the hero is John Kerry, the author of the book. Okay, so he kind of says, a reporter with the Wall Street Journal. You know, that's kind of the way that was read. And it's just, yeah, okay, yeah. What's that? Well, the Truman Capote, yeah. So just basically makes himself the hero in the book. Yeah. Yeah, that makes sense, yeah. So yeah, that's where we're at. We're about to see the involvement of John Carreyrou and how the whole thing unravels, but it'll be an interesting time for sure. And so, yeah, let's go ahead and talk about CPA prep now. Which I know that's the whole reason that everybody's here, okay? Because you have not had enough questions as of late about accounting and auditing in general. All right. During testing, an auditor identifies unrecorded accounts payable of $50,000, which is determined to be a material amount for the year under audit. How should the auditor record this amount in the summary of possible statements? Assuming that overstatements are recorded as a positive amount and understatements are recorded as a negative amount. So this is not something we talked about directly, and I wanted to bring this up. That being said, I want this to be a lesson about something. If you encounter something in your testing or your preparation that you say, I don't know what this is about, I don't remember this. First of all, be very, very certain that it's not something you've ever covered before, okay? There's going to be a lot of information on the CPA exam in general and be a lot of information in auditing that you're going to say, I don't remember this. If you just do some basic review, you may find out, oh yeah, I do remember covering this, and so this is something I can do. But this is an example of something we did not cover directly. We did not talk about the summary of possible misstatements. It is not a difficult concept. Basically, at the end of the audit, the auditor is going to put together a summary of whatever they identify as misstatements over the course of the audit. They're going to say the result of this misstatement is this account is overstated by this amount, this account is overstated by this amount, so on and so forth. So you prepare that, you give that to the client, and the client, you tell the client, you are materially misstated by this amount, you need to make adjusting entries to fix this problem. That's effectively all the summary of possible misstatements is. It's pretty straightforward and pretty easy to follow. This is a question of, in this particular scenario, what would be conveyed in the summary of possible misstatements. So the first part's pretty easy. It's an unrecorded accounts payable, all right? The accounts payable was not recorded. So if it's not recorded, does that mean accounts payable is understated or overstated? It's understated, okay? Understated. And we know accounts payable to be a liability account. So that means liabilities are going to be understated. So it's going to be a negative number, so 50,000. Now, if we have an unrecorded accounts payable, we know from our lessons on liabilities that we learned about in 417 that all liabilities eventually have a corresponding expense entry that offset those, okay? If that's the case, an expense entry did not get recorded, all right? Now, what do expenses traditionally do in income? Do they increase income or decrease income? Decrease. So if it did not get recorded, that means income is going to be overstated, okay? So we're going to have understated liabilities of 50,000 and overstated income before tax of 50,000. So B is our answer. When issuing an unmodified opinion, the auditor evaluates the audit findings should be satisfied. That's the what? Let's just go through the answers, okay? Amount of identified material misstatements are documented in the manager representation letter. Have we talked about documenting any of this information in the manager representation letter? What is the manager representation letter, by the way? We have talked about that.
Letter written by the auditor from the perspective of management.
Right.
Says, hey, this is everything management gave us.
Yeah. Did they give us the misstatements? Is that something management gave us? Probably not. So that's not going to be in the manager representation letter. All right. Estimate of total misstatement is less than the material amount. Okay. Should we be satisfied that the total misstatement is less than a material amount? That's kind of the whole goal of the audit, to make sure the financial statements are free from material misstatements. Okay. So B is our answer, but let's go through the rest. The amount of factual misstatements are acknowledged and recorded by the client. We don't actually care what type of misstatements they are. We are going to make sure that they're acknowledged. They don't need to be reported by the client. They need to make adjustments for those. Okay. The estimate of total misstatements include adjusting entries that have already been reported by the client. That doesn't really make any sense. If they've already adjusted for a particular item that we think is misstated, why would we include that again in the estimate of total misstatements? Because that's already been adjusted for. So, B is our answer. We disclose to you all known instances of non-compliance or suspected non-compliance with laws or regulations whose effects should be considered when preparing financial statements. Speak of the devil. We just talked about something that sure sounds like this. What does this sound like to you guys? Sounds like something that management is making a representation about what they provided to the auditor. What would that be documented in? Something that might document management's representations. Should it be the manager representation letter, you think? How many people think it's going to be the manager representation letter? Okay, Tyler, what do you think it is?
Well,
Okay, all right. I was just trying to catch you off guard. It's manager representation letter. Yeah, okay. Which of the following factors would most likely would cause an auditor to question the integrity of management? I actually really like this question. Okay, this is a judgment question. Most of the multiple choice questions will not get to the level of analysis or evaluation, but I think that this is probably getting to the point of close being that. Most of the analysis and evaluations are limited to TBS questions, but I do think that there are some more challenging ones, and this one's a really good one. So management has an aggressive attitude toward financial reporting and meeting profit goals. Now, that is something that we would probably be concerned about as a risk to the organization. It would definitely be a pressure, but does that necessarily imply something about the integrity of management? Not really. It just says that we want to make sure that they meet their earnings goals so they get their bonuses. Okay. So if I were to say, in absence of this, in absence of anything else, this might. Okay. Very remote possibility that this might. Audit tests detect material fraud that was known to management but not disclosed to the auditor. So management knows about a fraud that's taking place, and they said, auditor just needs to know about this. Does that sound like integrity issues with you? Yeah, I think that's our answer, but let's go through the rest. Managerial decisions are dominated by one person who is also a stockholder. This would be blaring red flags to me. I'd be like, there's a problem. There's an entrenched management issue here. There's probably going to be conflicts of interest in this. But again, this is not a signal of integrity. This is just a signal of bad design of the system, of their structure. Weakness and internal control reported to the audit committee are not corrected by management. Okay. So we know that weaknesses need to be reported in internal controls, and they should be corrected on a timely basis. That does not necessarily mean that there's integrity issue if they don't fix it. It could just be laziness. It could be a judgment call where the management doesn't say it's an important issue. If they say it's not a material weakness, but it's a significant efficiency, it doesn't need to be corrected immediately. So this was an interesting question. I think if you came up with B, you came with the right line of logic, but I can understand why they might find that challenging. So this one's an easy question, okay? LTRP is an external audit firm hired by Audit Financial Statements of Kraft Company. Kraft recently implemented a new internal control system based on the components and principles of the integrated framework. Which integrated framework do you think they're referring to? The only one we've ever talked about.
the sponsoring organization.
It's the COSO Internal Integrated Framework of Internal Controls, or Internal Control Integrated Framework. Categories of deficiencies that LTRP may identify after evaluating Kraft's internal controls include all the following except what? So 3 of these you should have been encountered before. 1 of these you have not. Which is the one that you have not ever encountered before? Critical weaknesses, that's not something we've ever talked about. That is their answer. That's all there is to this. However, just for context, let's go through these and make sure we understand. If I have a deficiency, if I've identified that it's likely there's a deficiency, okay, because remember, likelihood is our first dimension that we evaluate on. I think it's likely there's a deficiency in internal controls, but I do not think that it's going to be sufficient magnitude to be a problem. What is going to be that baseline level of deficiency? What do we call that? Give you a hint, it's a deficiency in controls. The control deficiency, that's our basic category. If we evaluate a control deficiency and we think, okay, the magnitude of this is probably significant, but not material. In other words, if left unchecked, it could become a problem in the future, but it's not a problem right now. What do we categorize that as? Significant deficiency, okay? And then if we believe it's likely to result in a material weakness or material misstatement, we call that material weakness, okay? So just as a reflection, if I'm the auditor and I find these things, who do I report to? So if I find a control deficiency, do I have to report that to anybody? Yep, I do. Who? Management. I have to report to management. If I find a significant deficiency, I have to report to management. Anybody else?
Governance.
It's charged with governance. Yes, usually the audit committee and the PCOB guidelines, but anybody charged with governance and the identification of other areas. And then what if it's a material weakness? Do I report to? I report to management, audit committee, anybody else? It gets disclosed externally as well because we actually have to requirement to report that in the audit report over ICOPR. Okay, so some information that we've talked about before, we're evaluating to make sure we're clear on. Clara, a CPA, has been engaged by Baxter Manufacturing and non-insured to perform financial statement audit. During the audit, Clara noticed that the company had a small number of employees. She also observed that employee A's job responsibilities included handling wire transfers, posting journal entries, and reconciling bank accounts. Well, there's a violation there. What do we call that a violation of? Segregation of duties. Yes, employee is managed to perform a supervisor review of all posted journal entries and bank reconciliations. Employee is managers perform this review because why? So we have an obvious segregation of duties violation here, but we've got a manager who's reviewing the work of this person who's responsible for these areas. What are some possible reasonings behind this? Let's go through the answers. One, it is a compensating control that can limit severity of control deficiency and may prevent it identified as significant deficiency or weakness. Have we talked about compensating controls with respect to segregation of duties before? If you don't remember, the answer is yes. We've talked about it on several occasions, okay? The idea being is that if there's a lack of segregation of duties, we can have reviews of supervisory personnel that can make up for the fact that there's a lack of segregation of duties in this area. All other things being equal, we would prefer that segregation of these responsibilities occurs within an organization, but there may be reasons why this is not possible. So let's go to question number part 2. By not having appropriate segregation of duties, employee has a better opportunity to commit fraud. Is that a correct statement? Yes. Okay. What might be a reason that we would not have proper segregation of duties? Okay. So you're saying, what's that?
Company's too small.
Company's too small. Okay. They have like literally 2 people in the finance position. There's 3 areas of responsibility to be segregated out. How do you separate that out? It says, well, we're going to clone one of the individuals, and then that clone can be responsibility for custody. Okay. It's obviously not practical to separate responsibilities out when you don't have that infrastructure. So this supervisor review is really important. So the answer is 1 or 2, 1 and 2, not 1 or 2, 1 and 2. C is our answer. That's all our multiple choice questions. Now, you know that if I only gave you 6 multiple choice questions, there had to be something to that, okay? It wasn't just that I was being nice and saying, you guys deserve a break after comps, okay? That wasn't it at all, because I gave you 2 task-based simulations, okay? How many people were really excited when they saw second task-based simulation? It was really Holden's like this. I wish I was on a boat again. Yeah. All right, let's get at it. Let's talk about the task-based simulations. Okay. If I can open this up. So the first one, during the course of the year 2 audit of the company, the auditor discovered the following situations that may or may not require an adjusting journal entry. Each audit finding is independent of other findings. So in the debit or credit columns, select the account or accounts or the options listed, and if they're required, correct the adjusting entry. If required to correct the audit finding, accounts may be used once, more than once, or not at all. All right. The bank's confirmation reply to the company's line of credit indicated the December year 2 interest was unpaid at year end. Accruals for the monthly interest expense have been made for 11 months in year 2 by the company. So has the accrual for interest been made in this particular scenario? We know that the payment has not been made. Has the accrual for interest been made? So it says 11 months. How many months are there in a year? 12, so probably not. That accrual has not been made. So how do we accrue interest expense in a financial statement transaction? Going all the way back to 220. It's like Dr. Barnes, I don't remember those days. I was young and I was innocent, naive then, and I didn't recall anything. Come on, you can do it with me. What are we going to debit here? Interest expense. We're going to debit interest expense, okay? And then we probably are going to debit some sort of payable, like we could say interest payable. It doesn't actually have that in the list, so what would be the most likely scenario that we would debit in that scenario? Payable is a liability, not accounts payable, but probably accrued liabilities. Everybody comfortable with that? Okay. Employee overtime paid for hours worked before year end, but paid in the following year were not recorded in year two. So basically, they have not recorded employee salaries, okay? So do we have another expense that needs to be recorded? Yes, because remember, matching principle says we recognize expenses in the period in which the revenues were incurred. The employee salary expenses need to be reported. So we're looking for salary expenses, but we don't see salary expenses here. So what's our next best option here in this scenario if we don't see salary expenses? Yeah, operating expenses, okay? Operating expenses. And then for same reason we talked about before, we've got accrued liabilities. This one I don't like. I would like them to be more specific in this scenario. But again, if you encounter a question like this, do not panic if you do not see what you expect. See if you can find something that's close to what you expect. All right. In the last week of year two, the company recorded revenue for services rendered in year three. Is this an appropriate transaction? So do we record revenues for the subsequent year and the current year? Well, let me say, yes, but I commit fraud, Dr. Barnes. So that would not be a GAAP approved transaction. We cannot record sales entries early, all right? So what would the transaction look like? So before we answer this question, what would the transaction have looked like to record the revenue in the current year? We would have debited what? So accounts receivable, okay? And we will credit sales revenue, okay? That's kind of our traditional sales transaction, accounts receivable debited, sales revenue credited. So to reverse this, we need to flip it. We need to debit revenues, and we need to credit accounts receivable. Now, I know what you're thinking. You say, Dr. Barnes, we never debit revenues, okay? We never debit revenues unless we are reversing a transaction to revenues, unless we're correcting a previous transaction that was incorrect. So this is one of those rare ones where we can actually debit revenues. Now, I don't want you leaving this classroom going and telling people, said, Dr. Barnes, it's okay for me to start debiting revenues now, okay? I will deny that with every fiber of my being. I will say it's okay under certain conditions. And that condition is we're correcting a previous journal entry that was improper, okay? During year two, a former client sued the company for inappropriate work. Legal counsel has advised that it's reasonably possible the company will be assessed damages. An amount can be estimated. All right. Harkening back to 303. Remember those days? Because you had Dr. Shaniwa for 303. You know, you had smooth jazz voice Shaniwa. Okay. So he was probably talking about contingent liabilities that says, yeah, in order to be able to accrue it into contingent liability, there are two conditions that have to be met. Has to be reasonably estimable and also what?
Probable.
Probable. Okay. We meet the reasonably estimable criteria. Do we meet the probable criteria? We do not. It says only reasonably possible. If it's only reasonably possible, do we accrue a journal entry here? Dr. Shani would come here and say no. At least he would if he was still here. But we can get him up on the phone and have him call and say, what do you think? He would say, what are we going to do? We're going to disclose this, but nothing else. Disclosure, but no journal entry requirement. Because again, it's not probable. It's only reasonably possible. So in that situation, we're not required to accrue a journal entry. And then in credit, you don't have to put anything. Just leave that blank. At the end of year two, a major customer filed for bankruptcy. Okay. So this actually is not a subsequent event. This is something that occurs before year end. Okay. But we would treat it like we would for a subsequent event. So we know that a customer files for bankruptcy. If that's the case, what's going to happen with their receivables? The receivables are just going to, they're going to pay us back the receivables because they care about us so much that even though they declared bankruptcy, they're going to meet their commitment to us, right? Wouldn't that be a wonderful world that we live in if that was the case? But unfortunately, we're going to assume that these receivables are probably not going to be recorded, okay? So if that's the case, we need to write it off. What's the transaction for writing it off? Well, we're going to debit This is the answer here, and I don't necessarily agree with this answer. It says debit operating expenses and credit allowance for doubtful accounts. Okay. Now, this is a problem that I have for this particular transaction. The reason I don't like this, what the answer for this one is that this is the entry that you would have to start to replenish your allowance for doubtful accounts, that you want to actually create allowance for doubtful accounts. Okay. The argument that's given in the answer is saying they don't actually have 100% certainty the customer will not repay, so they want to create a bad debt expense to recognize this allowance for doubtful accounts. My assumption in this scenario is that we're going to recognize this as an allowance, that we've already created the allowance. We're going to recognize this as an uncollectible account. So my journal entry that for this one would actually be allow for doubtful accounts and credit accounts receivable. So there's two possible answers depending on whether you believe this should be written off at this point in time or not. The Becker says it's not supposed to be written off yet. We just need to create a bad debt expense to recognize the probability of being written off. I say if we're in this scenario right now, they're bankruptcy and we're actually recognizing the bankruptcy, time to write it off. We can always reverse the write-off if necessary later on, but it's better to be safe than sorry. All right. So yeah, depending on what your answer is, two possible answers there. There's my answer and then there's the correct answer, I guess. So, all right. All right, so we audited accounts payable, we checked the misstatements, proved this undetected by client. All misstatements related to year 2. So we're going to use the exhibits above, which are the exhibits to the side, actually, because I don't put them above. Indicate the procedure is most likely used to detect a misstatement and select the internal control that can be used to prevent or detect this type of misstatement in the future. All right, so we got some exhibits here that can help us out. So misstatement of accounts payable of 15,000, which you can't really answer that until you look at the nature of the misstatement. So it says that there was an entry to record an accounts payable that never got recorded. And the reason why is because the accounts payable clerk misplaced invoice for raw materials that were received in year 2. So there should have been a recorded record of inventory being received and accounts payable being recorded for the payment of that, but never got recorded. So what would be something that you as an auditor would do to actually determine that this took place? So we got a document that got misplaced by the client. According to this scenario, the accounting clerk misplaced the invoice. So is it just the auditor going into the accounting clerk's office and saying, you know what, I'm going to look and see if you misplaced any invoices. So I'm just going to go searching around your office and I'm going to check behind your desk and I'm going to check behind your computer. You guys need to interrupt me because I'm going to continue going on with this until somebody says, no, that's not what happened, Dr. Barnes. That's not what happened. Thank you very much. All right. All right. So that's not what happened, obviously. So how do we know that there's an invoice that did not get recorded? Is it possible that there were other documents that are associated with that invoice that we're looking at and saying we don't have a matching document for this? What might be some possibilities? There's the purchase order. More likely is going to be something more recent to the invoice. What is that document called? Receiving reports. Okay, so we were investigating unmatched receiving reports. And we found, oh, we got this unmatched receiving report. Why does this not have a corresponding invoice? Because the clerk misplaced it. Clerk said, oh, it's my bad. I placed it under my chair to fix a squeaky wheel. My bad. My bad. I didn't think the invoice was important. Who does with paper invoices anymore anyway? Kyle, do you do any paper invoices anymore?
I don't really work in that department.
Okay. All right. All right. All right. So what are we going to do as far as internal controls that would prevent or detect the misstatements in the future? All right. So in this particular scenario, obviously, if we've got unmatched documents, we want to make sure that they're matched. So could it make sense that we actually have some sort of process where the client has a control in place that says, if there's an unmatched document, we investigate further? That makes intuitive sense. But before you look at the answers, what would you actually look at for the answer to be? Something about trying to identify any unmatched documents and a procedure for doing that. So what are some documents that we talked about that could be matched to this? Because the invoice received, but we want to match it to previous documents. What are some previous documents? We know the receiving report. Any other previous documents that we can match it to? Purchase order, yeah. All right. So purchasing orders, purchase department. Let's see if I got this right. Purchasing department supervisor reports a listing of matched purchase orders and receiving reports to the accounts payable supervisor for comparison of vouched invoices. Okay. If we've got some items on there that do not match, then we can actually make sure that we follow up, investigate. Where's that invoice? All right, misstatement of accounts, 1250. All right, accounts payable incorrectly recorded invoice number 256872. I don't know why I read that. For December year second for supplies in January year third. So supplies were recorded in year three instead of being recorded in year two. All right. So this sure sounds like a cutoff issue to me, doesn't it? Sound like a cutoff issue to you? How would we have found a cutoff issue?
The cash disbursements for
Before and after year end, okay. Specifically, if we're talking about year end, we would be looking for that particular item that should not have been recorded in year three and looking at one's year two. So yeah, from the year three cash disbursement journal, select payments and match the corresponding invoices. All right, so control here. We're gonna have another matching process here. Obviously matching here, but we want to match according to the date, not necessarily according to previous transactions items, okay? Make sure that these are included in the proper period. So that's kind of what we're looking for. Clerk is responsible for matching purchase orders, their receipt reports, and making sure they're included in the proper month. That sure sounds like cutoff to me, and we're happy there. Then we have a control deficiency. What is our control deficiency? We may need to budget more time for accounts payable testing. Alert today, the accounts payable manager might be approving and cutting checks. I'm going to investigate this further, okay? So we got a segregation of duties issue, So we talked about this before. We're talking about testing segregation of duties. What is generally our first step? This is actually one of your CPA exam questions. What's our first step? Generally not our last step, but our first step is personal inquiry and observation. So we want to know about the process. So let's look for something that looks like personal inquiry and observation, okay? So what do we got here? Select an unpaid invoice and has to be walked through the invoice payment process. So that sounds like a walkthrough, but does a walkthrough contain the inquiry and observation? Sure does, okay? And that actually encompasses the entire process of what we'd be doing. We start out and say, okay, tell me about this, what this step this invoice would walk through to actually go from inception to any of the financial statements or entering into the financial system. Okay, can you show me the documents that actually be compared to, blah, 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 blah. A lot of questions, a lot of observation, and then we necessarily reperform the task to make sure that we have understanding. So a walkthrough kind of encompasses all of that. All right. Now, what is going to be our control here to make sure that we have proper segregation of duties? Okay. To make sure that should the control be segregation of duties? Sounds pretty good to me. Okay. Sounds good to me. So what do we got here? Segregation of duties. What area is this in? This is an accounts payable. Accounts payable or personnel are assigned different responsibilities each quarter within the department. Now, that's a weird thing to say to each quarter. That's not something I've traditionally seen, that they like rotation, but maybe this is more referring to the fact that we check this each quarter to make sure that accounts payable personnel have responsibilities separated out. Not that they rotate between responsibilities each quarter. That'd be kind of cool because like being on a football team and everybody gets a chance to be quarterback. That was a great thing when you were a kid. Everybody got a chance to be quarterback, and then all of a sudden, then you get to be older, and then only Patrick Mahomes gets to be quarterback, and everybody else is relegated to the other positions. Yeah. Okay. Misstatements of accounts payable, $12,670. Okay. So let's go ahead and take a look. Receipt report 2,450 dated 12/28 year 2 for purchase of raw materials was misplaced by receiving report, and therefore no liability was recorded. So the receiving report was misplaced. This sounds a lot like what we just talked about in this one up here, because we're gonna have document matching, right? So what were the documents that we talked about up here? We talked about the purchase order and the receiving report being matched to the vendor invoice. Is it possible that we could have a similar matching process, but we just say, what are the documents to match to the receiving report, and be the purchase order and the vendor invoice? Yeah, so that would be something that we'd be doing as auditors. We'd be looking at purchase orders and vendor invoices that are open and investigate what's going on. Why are these still open? Like, oh yeah, we did receive this. We never got the receiving report. Okay. So in that case, we want to make sure there's a control that does this matching process. So the accounts payable supervisor reviews a month listing of open purchase orders and vendor invoices for following up with the receiving department, making sure that we understand what's going on in receiving and that we've actually received the goods that we're paying for. How do we do on that one, guys? Feel pretty good? You did pretty well, great. If you were struggling on that one, make sure you review the content that we talked about in here. This is kind of foundational content to make sure you understand what it is that we're doing as tester controls and making sure that the follow-up controls align with what we expect them to look like. Okay, I know this one was a little bit challenging. It was intentionally challenging. I wanted to kind of challenge you all in this one, for lack of a better word. I'm going to say the word challenge one more time. All right. Have a good weekend. I'll see you all on Monday.